Welcome to a 50-day equity valuation briefing on Inari Amertron Berhad, one of the premier assets listed on the main market of Bursa Malaysia. To qualify as a Sharia-compliant investment, an asset must pass rigorous screening against three prohibited activities: riba, or interest, gharar, or uncertainty, and maisir, or gambling. Incorporated in 2006, Inari is a dominant player in outsourced semiconductor assembly and test, or OSAT, and electronic manufacturing services. The company maintains expansive physical operations across Penang, the Philippines, and China, a deliberate strategy designed to minimize localized geographic and operational risks. The Sharia Advisory Council of the Securities Commission Malaysia has officially categorized Inari as a Sharia-compliant security. This status is a direct result of its core electronics manufacturing business being entirely permissible, alongside financial leverage ratios that sit well within strict regulatory thresholds for interest-bearing debt. For institutional investors, this represents a highly specific utility: the ability to participate in the growth of global high-tech supply chains without violating domestic Islamic finance mandates. The instrument we are evaluating today is ordinary shares. Unlike fixed-interest bonds, this equity provides investors with direct business ownership, voting rights, and the potential for capital appreciation. Because Inari is an export-driven business that generates revenue in US dollars, its balance sheet is largely insulated from localized Malaysian economic cycles. The company specifically focuses on high-end production, processing radio frequency components, fiber optics, and advanced integrated circuit packaging. These are the exact hardware components required to power current global technology expansions, specifically the rollout of 5G networks and artificial intelligence infrastructure. By securing an asset heavily tied to these international technology cycles, domestic investors effectively bypass local retail, property, and banking volatility, significantly reducing the systemic risk within their portfolios. Looking at the daily chart over a 50 trading day window, we can identify a distinct and robust ascending price channel. Notice the price action relative to the 200-day moving average. The stock is currently trading well above this critical baseline. This positioning signals market sentiment has transitioned from a phase of markdown into institutional markup. Within this trend, we see a clear continuation pattern beginning with an aggressive, high-volume price upswing, forming the flagpole. Following that vertical move, the stock enters corrective consolidation, drifting downward between parallel trend lines to form the flag. During this phase, selling volume drops off significantly. The market is successfully absorbing profit-taking, pointing to strong ongoing positioning by institutional traders. Mapping the next leg using a Fibonacci expansion, the 1.0 level projects a clear target of 2 ringgit and 70 cent. For those executing this setup, the optimal entry sits at the retrace near the flag pattern's lower boundary, aligned with the moving averages. The alignment of an established uptrend channel, solid 200-day moving average support, and a classic bull flag breakout yields a highly favorable risk-to-reward scenario. This chart structure is backed by strong underlying financials. Here is the statement of profit or loss for the fiscal year ending June 30, 2025. Looking at the bottom line, the net profit attributable to owners sits at 218.7 million ringgit. To gauge how efficiently that income was generated, we measure it against the total equity provided by the owners, which is 2.76 billion ringgit. Dividing the profit by the equity gives us a return on equity of 7.91%. Generating this level of return during a known cyclical downturn in the broader semiconductor industry proves a high degree of operational efficiency. Moving to valuation multiples, the basic earnings per share generated by the company is 5.78 sen. Measured against our tracking period closing price of 2 ringgit and 28 sen, Inari trades at a price-to-earnings ratio of 39.45. That multiple is undoubtedly higher than what you would find in domestic retail or defensive sectors. However, investors accept this premium multiple specifically to secure exposure to the high-growth trajectory of next-generation global supply chains. With a solid 7.91% return on equity and direct integration into global 5G hardware production, the premium valuation is well supported by the business model. In terms of returning capital, the company has maintained a historical dividend payout of 5.50 sen per share. At the 2.28 ringgit benchmark, that provides a dividend yield of exactly 2.41%. For value investors, this yield functions as a protective floor, absorbing some of the inherent volatility that comes with highly capital-intensive technology stocks. But the true measure of Inari's safety lies in its balance sheet, specifically its debt management. Looking at the latest financial statements liabilities section, there are absolutely zero bank borrowings on the books. The only debt is minor lease liabilities. When we divide that 14.6 million ringgit lease liability by the 3.09 billion ringgit in total group equity, the debt-to-equity ratio resolves to a nearly non-existent 0.47%. Even if we factor in every single liability across the entire group, the total liabilities-to-equity ratio remains incredibly conservative at just over 10%. The ultimate counter to any remaining risk is found right here. The company holds 2.14 billion ringgit in deposits, cash, and bank balances. This massive net cash position neutralizes the threat of international interest rate hikes and safeguards Sharia compliance by eliminating the need for conventional interest-bearing loans. Operating with a 0.47% debt-to-equity ratio and zero bank borrowings leaves the core financial stability of the firm virtually unassailable. Bringing the fundamental financial data and the technical charting together paints a very clear picture of this asset. Fundamentally, Inari runs a highly efficient by a 2.41% dividend yield. More importantly, it achieves this growth with essentially zero debt, holding a leverage ratio of just 0.47%. Technically, the chart shows an asset heavily supported by its 200-day moving average and breaking out of a proven bull flag continuation pattern. The math of that breakout points directly toward a medium-term technical target of 2 ringgit and 70 cent. While macroeconomic variables like cyclical semiconductor demand and USD to ringgit currency fluctuations will always present short-term headwinds, those variables are heavily mitigated by a cash-rich, zero-borrowing balance sheet. Combining extreme balance sheet safety with global technology manufacturing access, Inari Amertron Berhad stands as an exceptional Sharia-compliant equity engineered for sustained capital appreciation.